So if you are confronted with stock price charts that look like these, on a year-to-date basis, the stock is up 18%, up 33%, and we're not even halfway into the year, what would be your most initial reaction? Are you afraid? Do you want to take some profits off the table? Do you want to let it ride out? I'm afraid that you are going to miss out even more gains. I think in this video specifically, let's try to spend some time to dissect the recent rally behind these two main Chinese big tech companies, namely Alibaba and Tencent, and just share my own thought process on how I look at them as investment vehicles and opportunities out into the distant future. Now, I think I just wanted to kind of quickly share my own current portfolio breakdown today and why this Alibaba and Tencent topic, I hold it so dearly and so closely to my heart. Evidently, I care so much about them because they are basically my two babies that take up a biggest part of my portfolio. Alibaba right now is at 36% and Tencent right now is at 17%. It's true, I think Alibaba, despite the recent rally from its lows, I think it's close to around 40 to 50%, but I'm still deep underwater and I'm still experiencing a negative 20% unrealized loss. Generally speaking, if you look at it in terms of how I weigh my portfolio, I'm still evidently a huge China bull. More than 70% is on a cost basis, and right now, because my US position has grown in value, while my Chinese position is still being dragged down by the Alibaba performance. So I'm not too sure why I'm getting comments, whether is it on X.com or even on YouTube, where people are commenting along the lines of, "Oh, Chikeng, you have lost your way, you are no longer the Chinese bull, I think you lost your passion, etc, etc. Maybe it's from my delivery, maybe it's from my past videos that I don't sound as bullish when I just started out, but truth be told, actions speaks louder than words. And does it look like I'm not a Chinese bull, at least from an allocation perspective? Clearly, I still have a lot of skin in the game. And of course, I foresee some comments coming in saying that, "Oh, why are you only sharing your portfolio when it's green?" And evidently, I don't only share my portfolio when it's green, and I've been posting regular updates when my portfolio is deep in the red. You can see it's negative 35%, negative 9.28%, why I hold more than 43k in Baba, why I'm down 24k on Baba. So clearly, that's not how I operate on this channel. So that's just some context. So these are the three key points that I'm going to cover in this video. First, I'm just going to briefly talk about a new super investor joining the Alibaba bandwagon. Secondly, I'm going to do a quick follow-up on the recent Alibaba and Tencent earnings. And last but not least, my entire framework and how I look at when to sell Alibaba and Tencent, considering that some of you have entered at the lows and are looking to take some profits and looking at this entire investment opportunities, whether that you can better deploy it elsewhere. So first things first, regarding super investors, I think there's this very famous quote that we know of, where there are many possible reasons to sell a stock, but only one reason to buy. So you can see that right now, out of 80 plus fund managers, there are 10 that have an explicit exposure in Alibaba. And out of this 10, there are 5 that recently added in the most recent quarter and 1 that actually reduced. So the one that reduced was actually Munger's Daily Journal Corp investment portfolio, and it seems like the new manager was basically trimming across the board. Now, there are two big moves that were made by super investors in Q1 of 2024. First was Michael Burry, and second was David Tepper. So Michael Burry, in my opinion, I don't necessarily follow him quite closely because he seems to be trading in and out of positions quite frequently, and that's not necessarily my style. But specifically for David Tepper, I think it's quite interesting. So he's managing a multi-billion-dollar portfolio, and you can see that he did add to Baba 158%, but on top of that, he actually added Pinduoduo, he actually added JD.com, he actually added iShares China Large Cap ETF by 2 as well. It seems like David Tepper is on the bandwagon where he's basically betting on the Chinese tech recovery and I guess China recovery in general. I look at many of these super investors just for investing ideas. So I don't necessarily follow them into a stock or out of a stock. Recently, many investors are on the lookout for higher yield on their idle cash. So you are in luck. Right now, Moneybull, which is a wealth management tool offered by Webull, can help you earn a yield by investing your idle cash into an underlying cash fund. So based on the 7-day yield, the USD cash fund, Moneybull, as of the 25th of March 2024, it has delivered an estimated of 5.4% USD per annum. And the best part, you can actually boost this 5.4% to potentially 8.4% if you are a new user to Webull with the new promotion campaign. So from their current welcome promotion, you can actually get an exclusive 180 days, 3% USD Moneybull interest booster. if you sign up with my link below. So on that same note, you can also enjoy really attractive sign-up promotions with different reward tiers when you meet the different requirements. The most basic, deposit at least $2,000 and make 3 US buy trades. Maintain your fund until the end of June to enjoy $200 worth of cash vouchers. So Weibo has been an amazing partner for my own personal investment journey, and I can't wait to see you guys there. So all the details to the campaigns will be in the link down below. So in terms of Alibaba's most recent earnings, I think there were 3 key updates for those of you who have actually missed out in my previous video. Firstly, I think in terms of the shareholder capital return program, they are stepping up their game. They are basically buying back a lot more shares, and they are delivering on their commitment where they are basically trying to make Alibaba share act like as some sort of a bond that pays you around a 4.25 to 4.5% coupon interest. So 3% will come in terms of the net buyback. So the 1.25% is basically the $1 USD per share that they're going to give back in terms of dividends. And assuming that they're trading at $80 per share, if they give back 1 over 80, that's around 1.25%. Now on the second point, there is this new tagline that was touted by the CEO where he's basically claiming that Alibaba is currently going back to growth. Personally, for me, as an investor that has been following Alibaba for close to 3-4 years now, I think there are many things that has still yet to be seen. There was a lot of missteps, a lot of strategic misalignment. I guess after many of these announcements and developments around the company itself, you can see that the internal management was not very well done over the last 2 years. So indeed, they did grow top line, and they did say that the GMV growth for their main business was in the double digits. But I think all things considered, the Chinese economy is currently undergoing some sort of recovery as well. So it's not necessarily something that only benefited Alibaba. So in this case, that's why I put a small note over there. And from the growth on the top line, it didn't necessarily flow down to the bottom line as well. And we do understand that they're currently reinvesting in terms of trying to upgrade their platform, upgrade their architecture, etc., etc. And I think the third point is really behind this idea of a China risk, a China discount, regulation uncertainty, Chinese equities being uninvestable. To me, I think it's a whole load of BS. It's very good for storytelling. It's very good for, I don't know who out there, the whales out there, to basically paint a story and to move the share price however they want to. And more importantly, I think in my previous video, when I talk about Alibaba specifically, I think Tencent has a much greater regulatory scrutiny, specifically in the gaming division and ARM, but Tencent seems to be recovering even stronger than many of its Chinese tech counterparts. So to me, I think most of it, they're just storytelling tools. So I think I just wanted to add 2 more points. Firstly, I think Alibaba is still in the game. Many people are casting aspersions in how the competition is eating up Alibaba's lunch. I think that's true to a certain extent. We can see that in terms of their market share, in terms of their margins, they're being compressed. They're being competed away. But I think if you were to plot everything in totality, Alibaba is still extremely strong. They're still printing a lot of cash flow. They're still taking care of shareholders. But that said, their competitiveness definitely took a hit. So if you just take a look of Alibaba's earnings over the trailing 12-month basis, it's true that their top-line revenue has grew by a much greater extent when compared to the previous year, which is from June 2022 to March 2023. So this year, they grew around 13, 8, 5, and 6% on the top line. But previously, they were experiencing some sort of negative growth rate and only a 2 to 3% growth rate. So that's basically an increase of around 2 to 3x. However, if you were to try to dig deeper in terms of their margins, in terms of their bottom line, even on their operating margins or even in their EBITDA margins, when you compare it to a year ago, it seems like margins from 2022-2023 is much better than the trailing 12 month. So they were doing operating margins of close to 12 and 14%. But this year, at least for the last 2 quarters, it was around 6 to 8%. Not very exciting, but I think we kind of have to give Eddie Wu and the execution team some time to basically show results. So that was the second point. We need to give time and space for the management team to execute on their vision. And I do understand, especially for investors that have been on this journey with me for the last at least 2 to 3 years now. Oh, you have been giving so much benefit of doubt to the management team. They've been underperforming. There's this new management team coming in. So how long more are you going to entertain such mediocre results? So to me, the business environment is dynamic. Today you can be on top, tomorrow you can be below. And that's basically what makes investing exciting. So at least from how I look at the mode of Alibaba today, they're still the biggest e-commerce platform. There is still a fundamental investment thesis around the economic mode, their network effect, their platform ecosystem, the stickiness of their users. So I think all things considered, so yes, they're probably less competitive compared to, let's say, 4 to 5 years ago. And of course, I'll be the first to admit, it's definitely not easy. But to me, I do think that the platform economy that Alibaba has managed to build over the last 20 years or so, they're close to unrivaled, and they are one of the most important companies in China today. So that's just my general thoughts. Moving on to Tencent's earnings updates. So firstly, Tencent is selling this margin improvement story to investors. Many of their metrics are improving significantly, specifically their gross margins on different earnings division. So there's also some sort of a growth turnaround as well if you look at in terms of their breakdown. Online advertisement 26%, fintech 7%. And in terms of the slowdown for many of their domestic games, because many people think that the CCP is out there to basically crack down and to destroy Tencent's domestic arm, they actually only fell by -3% year on year, which is why Tencent is also selling this gaming retention and adaptability story. I think all things considered, when looking at many of these Chinese big tech companies from Baidu, Meituan, Alibaba, Tencent, Tencent is really one of the few, if not the best, in terms of adapting to many of these regulations, working together with the government, and trying to achieve a win-win solution. So I guess that's just a superpower of Chairman Ma, or Ma Huateng in this case. So Tencent, from their lows of around $200 per share, they're up nearly 100% from their all-time lows. So it's evidently another case in point that capital is not discriminatory. They honestly do not care where they're investing in, whether it's in China, in whatever parts of the globe. As long as there's an opportunity, capital will flow there. So I think over the last 2 to 3 years, investors have already acknowledged their fate. There is a lot of uncertainty around Chinese tech, but I think some of these businesses are still some of the best in class, and buying at such cheap valuations today, it's really kind of a no-brainer. So for Tencent specifically, I think the gaming overhang is still there. Games in general is not really favored upon in China, but evidently investors and the stock market don't really care. But to me, when I buy into Tencent, I'm really buying one of the best in class companies. They basically have penetration in the entire Chinese economy. They have a super app, they have a fintech app, they're in cloud. They have so much properties, digital properties, to spread their online advertising. They're in e-commerce, they're basically everywhere. And you probably cannot appreciate the width and the breadth of Tencent's exposure and penetration into the Chinese economy. And which is why it has always been the underlying and the fundamental investment thesis for anybody remotely interested in investing into Tencent. So now, going to the main topic for this video, is it time to take profit? Specifically, for many of you that are in the stock for the last 2 to 3 years, I will presume that many of you have PTSD, because when you look at the stock price or the stock chart that I'm showing right now, you can see that they're basically range bound, and there is a lot of fake outs where they trade to above 120 and then it drops to below $80 per share. It goes back up, it comes back down, and then it just zigzags from here. And right now, it seems like there's a mini breakout, and many investors, or I guess many backholders in this case, are very excited, or at least they're very excited to exit, because they don't want to be taken on this joyride again, where you might see Alibaba even potentially rallying to 120 and then get rejected downwards again and sell down. It seems like you didn't harvest your ripened fruit, and you are the foolish one here. So I think to simply answer this question of whether is it time to take profit, I'll just pose 2 separate sub-questions. First, what was your initial game plan? When you bought into Alibaba or Tencent for that matter, what do you wanted to do? Were you trying to bet on a mean reversion? Did you buy on technical analysis? Was it a trade to begin with? Or was it really you trying to invest for the long term, looking at China's depressed valuation, look into Tencent's business, look into Alibaba's business, you think they are one of the best in class, you want to invest in the Chinese consumption story, the Chinese consumption recovery, etc., etc. So if you're investing, there should be a game plan for an investment perspective. If you're trading, then there are definitely take profit, stop loss zones. And the second sub question would then be, so was there any change in your thought process? Maybe some of you might think that, investing into China is no longer my cup of tea. There are a lot of things that I didn't know when I stepped into the investment, etc., etc. So once you kind of get to have some sort of clarity to these 2 questions, then I think you would know whether you want to take profit, whether you want to take chips off the table. So to just share my own personal opinion, to me, I think for those of you who have been following me long enough, I am in it for the long haul. To be honest, even buying into Baba since end 2020, it's close to 3.5 years now. I think I'm just getting started. I don't even mind holding until 2027, 2030, 2035. Barring those kind of existential crisis and the fundamental economic mode of maybe WeChat deteriorating, I think that's it. I do think that I'm buying into some of the best businesses in the world. So just my own personal opinion, I've held Baba since 2020 and I've averaged down from 220 to 240 all the way down to 109. So clearly, I'm still underwater right now. For Tencent, I've bought in since July of 2022 and I've been averaging up in fact. So for Baba, I've been averaging down. For Tencent, I've been averaging up, and currently my average price is around 295 Hong Kong dollars per share. So I don't usually trade in and out of positions unless they're options positions, so it's more time sensitive. But that's it. I think fundamentally, I think there's still some of the best businesses to own. It helps, especially when there's a lot of fear around them, and it makes the valuations extremely compelling. Overall, when I look at the downside, I think barring any black swan, I don't believe there's much room to fall further if you hold it long enough. And I've been perpetuating this idea, or at least this is just my perspective. So from a risk-reward point of view, that's just my own takeaway. You can seek to disagree in the comments. That's just how I look at this entire investment opportunities today. So most factors are not working in their favor right now, from politics to regulation to the macro environment to competition. But that's precisely why you're offered this deal in the market. Given the current valuations that I'm entering, I do see a very big margin of safety for a lot of things to go wrong, and I don't think I'll lose a lot of money. When I look at Alibaba today, if the base case is that they will continue to chug along, growing between 5 to 10% out into the decade, meaning out into 2030, and maintaining their competitiveness in the growing industry, I don't need them to snatch market share back from ByteDance or back from Pinduoduo, etc. I just need them to remain relatively competitive in this growing industry. I think that's enough for our base case assumption. So they've delivered roughly around 21 to 25 billion in free cash flow. So let's assume a case where they are only delivering 20 billion. So that's a discount again from what they've done for the last 2 years. And of course, ignoring many of these storytelling about how China is being uninvestable. So they're currently in a depressed state. I think many people can attest to that fact. So I think in this base case, let's assume that they trade at a 5% free cash flow yield instead. So this 5% is already kind of factoring some sort of China discount, whatever that means. Because if you look at many of these US tech counterparts, they are trading closer to 2.53%. So this 5% free cash flow yield is already a double in terms of the premium that investors are looking out for. So that's a baseline of $400 billion in market cap. So that's an easy 2x, meaning they should be trading at least $180 per share. And also, let's not forget that this projection is out into the decade. So there's still 6 more years. The above 20 billion in free cash flow is a pessimistic case. And also, let's not forget the capital returns program, where you have the additional 1.5% returns that comes in dividends. And if you multiply it by 6, that's additional 9% return on your capital. I think similarly, when I look at Tencent, using the same base case, meaning that they grow between 5 to 10% to the next decade, maintaining their competitiveness, I actually do believe that if you compare Tencent and Baba, Tencent is in a much better position. Their business is much stronger. Fundamentally, I think growing at 5 to 10% is what they've been doing over the last 5 quarters. I don't see why they're not able to do so again in the coming 6 years. So they've delivered around 18 to 28 billion in free cash flow over the last 5 years. There's quite a bit of fluctuation, but let's assume a base case of 25 billion free cash flow per year. And we ignore similarly the depressive state and say that they trade at a 4.5% free cash flow yield. So why not use 5%? Because I do think that Tencent is a greater business. So the premium or the discount in this case required is smaller, or the premium that people require is smaller. So investors are willing to buy it a little bit more expensive. And that means that they have a baseline market cap around 550 billion, purely from the free cash flow yield perspective. And on top of that, you have to add back in the investment portfolio. In the latest quarter, it's valued around 120 billion. So they're currently at 480 billion. And if you were to look at how much they are supposed to be valued at today, that's easily another 40%, which means that they should be trading at around 550 Hong Kong dollars per share today. Also, I'm not forgetting that this projection is out into the decade, so there's still 6 more years, and the above 25 billion is really a pessimistic case. And of course, not forgetting the capital returns program via the buyback, their dividends, and the special announcements. And for myself, I've already participated in one special announcement where they gave out Meituan shares, and then bumped up the entire dividend profile to close to, I think, 4%. So all these accumulates over time. So I think if you look at it in totality, when I look at both stocks today being offered to me by the market, if I indeed do have a long enough time horizon out into 2030, I do think Baba hitting $250 per share and Tencent hitting $800 per share isn't too big of an ask, all things considered. So holding Baba for 10 years from end 2020 to end 2029, 110, which is my cost price, to 250, is a 8.5% CAGR excluding dividends. And holding Tencent for 8 years from mid-2022 to mid-2030, 295 to 800 is a 13.2% CAGR. And this is of course excluding dividends and any share giveaway or special announcement. So of course, I think this 8.5% might not be extremely sexy to some people, and this is my fault. There's nobody else's to blame, because if my cost price today is closer to $70 or $80, this CAGR would look a lot more beautiful. And some investors might bounce back and say, why spend so much time looking into specific stock investments when you can just buy the S&P 500 and you get a guaranteed, air quotes, 7 to 10%. I think my main gripe with the argument, 3 points. Number one, nobody guarantees 7 to 10%. So many things considered, some of you might want to stress test that assumption. Number two, I think everything that I've done, or these computations that I've did in this presentation, is very conservative, and some bigger bulls out there might think that it's even borderline pessimistic, which I think is good because it leaves a lot of room for upside surprises. So that's why from a risk-reward perspective, I don't see a lot of risk. In fact, I do see a lot of potential upside. And I think last but not least, it really depends on your conviction on many of these companies that you study. And I just so happen to study the Chinese tech industry, Alibaba and Tencent, for quite some time now. And I've made a lot of videos, I've read a lot of articles, I've discussed with a lot of people, whether it's from a user perspective or from an employee perspective. I do have a deeper appreciation, which also kind of builds my conviction. So that's just generally why I'm such overweight to many of these tech positions, and specifically Alibaba and Tencent. So I hope that I gave a holistic enough picture for those of you considering to take profits. I think there is no harm trying to take profits, but at least for myself, it was never in the picture. So hopefully, 2024, the year of the dragon, is a great year for Chinese tech companies. And I'll see you guys in the next video. And hopefully, and finally, I'll see you guys on the moon. Goodbye.